Okay, welcome to the final exam prep video. First of all, let's go over what the final exam format's going to be. If we look down here, we see that on the left column, total amount of questions is going to be 31. That's approximately what we've been having before. I've just changed up the mix a little bit. There are just like on the regular exams, I think there are 102 points. In other words, 2 bonus points sort of embedded. There's going to be 3 bonus points. You'll have an hour to complete it. Now, how is the makeup different? Well, we've got a focus section on chapters 10 and 11. And just like before, we're going to have a certain amount of C, B, and A questions for chapters 10 and 11. The C questions are going to be taken from the quiz. Quiz 4 is up and is doable. Please do it as many times as necessary to be understanding of the content there, to be familiar with it. That's the word I was looking for. Now, because it's only 2 chapters, it is 30 questions in this quiz. So I will be choosing 10 of the 30 questions, and they are 5 points each. Remember, that's a double-edged sword. I'm giving you these questions, but please don't miss them because they are, well, they allow you to, know the questions beforehand, but please make sure you get them because that'll be the bulk of the points on the test. There are going to be 5 B questions and 5 A questions. The B questions are 3 points each. The A questions are 1 point each. They're going to be taken from this document. We're going to go through the B and the A questions here in just a moment. Also, Accounting 210 is a cumulative final exam. And so there are going to be 11 questions. They're all going to be C-level questions. And they're only going to be taken from the quizzes 1, 2, and 3. So there's not anything extra that you need to do or any other extra material that you need to study. You've already studied quiz 1, 2, and 3. All you need to do is go back and do those again to make sure you're familiar. I'm not going to make up any new questions. I will just pull questions from quiz 1, 2, and 3 as my cumulative questions. Now, normally we make C-level questions 5 points each, but because these are the cumulative questions, they're C-level questions, but they're worth 3 points each, and there's 11 of them. And so all of those points together total up to 31 questions, 103 points. What are my tips on the cumulative section? Well, I want people to come away from the intro level accounting by stressing the basics of accounting. And now I'm looking in the right-hand column. So what are debits and credits? What is the accounting equation? What are T accounts? What are the financial statements and their correct order? Remember, we did income statement to come up with net income. We used the net income in the statement of owner's equity. We use the ending owner's equity as part of the balance sheet. And then while we haven't done it, there's also a statement of cash flows. Then, according to the accounting cycle, there were 2 more major things we needed to learn that were the adjusting entries, the accruals and deferrals, and the closing entries. Most of these topics are actually covered in quiz 1, so pay a special attention to quiz 1. And again, pay attention to these particular questions in the quiz because those are the ones I'm going to be pulling to make up the 11 questions. Now, will I choose anything from the inventory section or the cash section or the accounts receivable set? Yes, I'll probably choose. There'll probably be a couple from there, 3 or 4 from there. So I'm looking at quiz 2 and 3 is going to still be helpful, but probably most of the questions are going to be pulled. The cumulative questions are going to be pulled from quiz 1. So that's the final exam format. It will be, I haven't put it on here. It will be Friday, which I think, well, I'll post this in D2L. It'll be Friday. I'll definitely put it. It'll be Friday, December 8th. Open from Friday, December 8th through Tuesday, December 12th. So those will be the days. Okay, well, let's take a look at the actual 10 and 11 sections. Chapter 10 was plan assets. Now, just to remind you, the way that the prep document works is that you use this in conjunction with the quiz, because the quiz question won't be exactly what this is. This is the information for the quiz question, but sometimes, remember, I ask you, a true or false question. Well, I'm not going to give you the false information in the prep document. I'll give you the true statement or the real information in the prep document, and then I could ask you a true or false statement. So you need to still do the quiz to make sure that you understand what the question looks like, but this is the basis on which I'm making the question. So a lot of these are informational bits. In earlier chapters, there were always a few computational, or usually there were computational things in here, but the only computational one that I have here is you just need to know, as a C-level question, you need to know how to do the straight line depreciation, which is C15 here. So straight line depreciation is always, remember, you take the historical cost, which in this case is $80,000 for the truck, minus the salvage value, whatever that gives you. In this case, it gives you $74,000, divided by the useful life. So straight line depreciation is historical cost minus the salvage over the useful life. And that is the annual depreciation amount. In this case, it's 7.4. And so all the other types of methodologies and whatnot, I will cover in the B and the A levels. And we'll get to those here in just a second. Here are the C levels for current liabilities. There are a couple of computational things you need to know as a C level. Here, what is the total interest expense for a short-term note? We've covered this recently. Just remember that the 12%, I'm looking at C18. Just remember that the 12% is the annual percentage rate. So if you have a note or a loan that's less than a year, you have to adjust it. So here you can see in the answer, we took 10,000 times 12%. So the annual amount of interest, if we took out the loan for a year would have been 1,200. But because that's for only half a year or 6 out of 12 months, we multiply that by half, and therefore our total interest expense is 600. Now in chapter 11, we went over to where we said, well, what if some of that interest expense was in 1 year versus of another? And that will actually be part of the B and the A level questions. The other one is here at C20. Just make sure if you're given the total sales plus sales tax number, but you're not given a breakout and you're only told the sales tax percentage, how do you get how much you record as sales revenue, or how much do you need to record as the sales tax payable? Remember, you divide by 1 point whatever the sales tax is. So here, 1232, if we wanted to know how much was sales and how much was sales tax, we take that 1232 divided by 1.12, and this 1100 is the amount of sales revenue. And then obviously if we subtracted 1232 minus 1100, that's going to give us the amount of sales tax. Let's see, do I have any other ones? There's some things here with some numbers, but that just is more informational. Okay. Let's take a look at the B and the A level in plant assets. So some of these are matched up, some of them are not, but let's take a look. So on B1, land was purchased for $100,000, an old warehouse. So this question here, if I had to say B1 was about, remember what costs get capitalized into land or just assets in general. So in addition to the purchase price for major assets, like buildings or land or equipment, there are a certain amount of costs that we add to the value of those assets, and we put them on the books. Normally, we might expense those; they'd be an immediate expense. But for certain things that are necessary to get the land or the equipment or the building ready for use, we capitalize the expense. And capitalize just means we add the cost to the value of the asset so that we expense it over time through depreciation. So here we've got a number of things, an old warehouse. So obviously the 100,000 is part of it. The warehouse property is also plus 5,000, but we received 2,000 for the salvage materials. So the 5 minus 2 is what we actually get from the demolishing. Additional expenditures includes $1,000 for the attorney's fee, apparently for the land sale. So that would be additional cost. 6% or not 6%, 6,000 for the real estate broker's fee. Yes. So all of those fees up to that point we're adding in. Now notice we have two others that we do not add in. The architect's fee. Well, the architect's fee might be something that we capitalize, but we would capitalize it to the building asset. An architect fee is necessary for the building, not necessary for the land. So even though it gets capitalized somewhere, it doesn't get capitalized on the land. And the $14K to put in the parking lot, remember there was a class of things that were nice to have, but not required. Anything that's not required by the state or city ordinance to put in, like maybe the state or the city, the county or the city says you've got to put in, a sidewalk, or you've got to put in, a sewage system or something like that. Anything that they require us to do, we will capitalize. Anything that we want, like signage or fencing or landscaping or parking lot, that's on us. We want that, and therefore it's not necessary. Therefore, it doesn't get capitalized. It gets put into a separate category, which we call land improvement. So the parking lot would be land improvement. So just those first couple would go into the capitalized part of the land. What is the reported cost of the land? So it'd be the purchase price plus those other items that get capitalized. A truck was purchased for B2. Truck was purchased for $80K with salvage value of $6K and 10-year useful life. What is the first year depreciation under double declining? So I'll note here B2 and A2 are the same question. A truck was purchased, except one says the first year, and one says the second year. So let's take a look at both of these and look at the first and the second year. So when we do double declining, double declining is going to be taking the book value times whatever the double percent is. So remember, if it's 10 years, well, that comes out to it comes out to 10% a year. So if we double that, it's going to be 20%. So the book value here times 20% is what is going to be the depreciation. Now remember, book value is historical cost minus accumulated depreciation. So the very first year, we don't have any accumulated depreciation. So what do we have for year one? That's supposed to be a Y. Year one, we've got 80,000 times 20% equals 16,000. And that's what you see in B2. Now, when we come to year two, well, what is my book value? My book value is 80,000 minus 16,000. This is the book value. Is now going to be 64,000. 64,000 times 20%, which is going to be 12.8K. So the double declining changes the amount each year based upon what the book value is. So if I were to do book value year number 3, it would be 80K minus, well, what is the accumulated depreciation? It would be year 1, year 2, and then we would figure this out and come up with the times the 20%. We're not going to do that. We'll just leave that there. Okay. Let's continue on. B3, what was the first year amortization for $480,000 12-year patent? This is not particularly challenging. It just uses a different word. Remember, amortization is an intangible asset, but it's still an asset that it doesn't get depreciated because we use that for physical assets, but it gets amortized. Now, remember, most intangible assets are amortized amortized on a straight line basis. So here, a very simple thing. The only thing that's throwing you off is if you don't know what amortization is, or you don't know what a patent is, you might get confused. But here it's just to take the full amount, $480,000 divided by the useful life. There is no salvage value particularly, and therefore it'd be $40,000 a year. Before, a truck was purchased for $80,000 with salvage value of $5,000 and good for $150,000. The truck was driven for 30,000 miles the first year. What is the first year depreciation under units of activity? So unlike B2, where we were doing double declining balance, and the second year we did, because it requires us to recalculate stuff between the first and second year. B4, I'm not asking for a second year of units of activity, because once you understand how to do the first year, you can do every year after that. There's no additional kind of understanding. So I only really asked the first year of this. So what is it? Well, what we're doing is we're trying to figure out how many, we're trying to figure out a rate. First of all, we're trying to figure out how many dollars per 1 mile, right? So how do we do that? Well, first we want to say, if we've got, this is for the units of activity. What is the amount that we're depreciating? Well, it's 80,000 minus 5,000 or 75,000, right? So this is $75,000 over 150,000 miles. Now, sometimes it's easy to get these two mixed up. Is this going to be 50 cents or is it going to be $2? Well, think about what is the outcome you're looking for. You're trying to figure out how many dollars per mile. Isn't that what you're actually trying to figure out? So you need to set up your equation in the same method that you're saying it verbally. I'm trying to figure out dollars per mile. Therefore, I put my dollars over my miles. So here, my rate is 50 cents per mile for 1 mile. So if I drove the truck for 30,000 miles, well, 50 cents times 30,000 miles is going to be a depreciation amount of $15,000 for the first year. And that's why I say, once you know how to do the first year, you know how to do every year after that. You figured out the 50 cents, then you look at how, if we drove it 50,000 miles next time, it would be $25,000 depreciation, et cetera, et cetera. B5. A company purchased a mine for $8 million that is expected to have 32 million tons of coal, 4 tons of coal. So just as we were saying, I can't actually point to B3. B3 is an amortization question, and amortization is straight line. Well, B5 is a depletion question, right? When we're talking about I don't want to say physical assets. I'm talking about resources, right? Land resources like timber or coal or iron. When we have something like this, we use the units of activity, and that's why I put it B4 and B5 next to each other. A company purchased a mine for $8 million that expected to have $32 million of tons of coal. Again, we need to do the same units of activity type calculation. Well, what does that mean? It means I want to figure out how many dollars per, ton of coal, per 1 ton. So I want to set it up as 8 million over 32 million tons. And therefore, if you just keep that in mind, what you're looking for, you will always get the correct rate. So here it'll be a quarter, 25 cents per ton. I don't know if that's realistic or not. But anyway, rather than get the number wrong, if you divided 34 by 8, you would get 4, you would mistakenly think it's $4 per ton, but really what you're saying is 4 tons per dollar, which isn't helping you calculate anything. So here, if we extracted 4 tons of coal, were extracted this question actually needs to read, I just noticed this. This question needs to read 4 million tons of coal were extracted, not 4 tons. Okay, I will correct that. But that should read 4 million tons of coal were extracted the first year. What was the amount? So if we multiplied 4 million times the 0.25, that would be 1 million. $1 million worth of depletion. Okay, let's look through A1. Company decides that a piece of equipment originally thought to have a 10-year useful life of 13,000 now only. So this is what we call a revised depreciation schedule. It's not that hard. All you need to do is take what is the existing book value, and here the book value is going to be, remember, historical cost minus accumulated depreciation. So the book value is 13 minus 6. So the book value is 7. And now if we're starting off at 7, and all we do is we kind of recalculate the depreciation using the new numbers. Well, it doesn't tell us that there's any new change to the salvage value. So we would say, okay, the salvage value would say, so if this is now the new cost base, and we say this is the new salvage value, I mean, not the new, this is the original salvage value. So this is the new depreciable value. And we're now depreciating it over 2 years. So we're depreciating it at, now remember these are in thousands. We're depreciating at $2,000 per year. And that would be, we don't have to do another journal entry. All we need to do is the next time around that we just need to start using 2,000 as our depreciation amount. Okay, we looked at A2, A3, what was the first year amortization? So B3 and A3 are the same question. B3 just said, what was the depreciation for a full year? Here, this is a depreciation for a half year because we bought it in the middle of the year on July 1st. So we do the same straight line, but then we adjust for the first year's amortization is going to be a half year. A4, a truck purchase for, so A4 and A5 are similar. A truck purchase for $13K with salvage value of $3K and a 10-year useful life was discarded after the 6th year of use. So remember, whenever we're talking about disposal, we don't just dispose what we think the book value is, because the book value is not an actual account. We've got a truck account with 13,000 in it, and we've got an accumulated depreciation account with it doesn't say, but if we did 13 minus 3, that would be 10 divided by 10 is 1,000 per year. This is our depreciation, and it's the 6th year. So there'd be 6 years of depreciation in here. And so the book value would be 13 minus 6, right? But, or $7,000. But what we're doing is we're apparently, for whatever reason, we thought it was going to last 10 years, but for whatever reason, it's complete junk now, and we're just throwing it away. We can't even sell it for cash. So what do we need to do? We need to get rid of these accounts. 13K here, so I'm going to have an equipment or a truck, a credit of 13K. I need to get rid of the accumulated depreciation. Let me separate it out here. Of 6K. Now you notice I've got a hole here. My debit to my credit needs to equal each other. So what am I going to call this? I'm going to call this a loss on disposal. And what we're really saying is I bought this truck for $13,000 and I only got a chance to use up $6,000 worth of its value. I'm really throwing away $7,000. Well, because I was going to use part of it and then I was going to sell part of it, but I'm just getting rid of it. Now, how is that like A5? Well, A5 is saying we're selling it. We're not getting rid of it. It's not junk. We're actually able to sell it. So the same situation is here. We've got a truck account. We've got an accumulated depreciation account of 6K. We still need to do the same things, right? Still need to get rid of, so here's the second one. We still have an accumulated depreciation account that we need to back out. We have an equipment account of the truck that we need to take care of, which is 13K. The difference here is that we're being paid cash for this. 8K. Now I look at this and I say, well, 8 plus 6 is 14 and this is 13. Well, what do I need? I need a credit. And am I getting more value than it's worth? Well, we said the book value was 13 minus 6 is 7K and we're getting paid 8K. Well, that means we're making a gain on disposal of 1K. So you can see the difference between throwing it away because it was junk was a loss of 7K, or being able to sell it because it was still useful for 8K means we made 1,000. So that's the difference between the 7 and the 8. Okay, that's chapter 10. Let's take a look at chapter 11. This one should be a little bit more straightforward. Chapter 10 just typically is a lot more work because it's all depreciation stuff. So B6, what is the amount of interest expense? We covered this kind of in the chapter 11 thing. Basically what we're saying is even though you have a 6-month loan, if the loan goes over the end of the year, you're going to have to split up the interest expense between the amount that was incurred, the amount of interest expense in the first year versus the second year, and it's going to be basically prorated by months. So even though this is a 6-month loan, 4 months of the interest expense, all of September, all of October, all of November, and all of December, 4 months of that interest expense happens in the first year. That's B6. And if we go over to A6, what is the interest expense that happens in the second year? Well, that's the January and February expense, and we come up with the calculations there. B7 and A7 are warranties. These are the two parts of the warranties that we've looked at before. If a company sold 1,000 refrigerators at $500 a piece with an estimated 5% defect, average of $70 repair cost per warranty with 40 actual warranties served, what was the debit to the warrant? So here, I guess the main thing here is the debit. What is the decrease? The decrease when we talk about the warranty liability. The thing that increases it is the estimate. The thing that decreases it are the claims. Remember, we create an estimate because we want to record an expense in the same period that the sales with the warranty happen, and then we leave that liability out there so that it can absorb the claims as they come in. So B7 is asking about what decreases it, which is the claims. The claims are talking about actual claims. So what are we saying? Well, there were 40 actual warranties served and at an approximate average repair cost of 70. So we look at those two numbers and those come to 2,800. When we look at A7, this is asking us the increase. So this is the decrease. This is the increase. So how do we estimate the increase? Well, we're going to say that's 1,000 fridges. It's going to be a 5% defect rate, or 50 times $70 per our estimate of the average, and that's going to end up being 3,500. So what did we do? We estimated that was going to be $3,500. Our claims came out to be a little less. It came out to be 2,800. So we set aside 3,500. People actually came in and took advantage of the warranty to the tune of 2,800. So therefore, what do we have? We have an additional 700 left in our estimate of the warranty liability. Okay, so let's see. The next three on both sides are going to have to do with payroll, and they're just various versions of stuff. So B8 and B9, if you notice, if you look at the last sentence, what are the gross earnings? What are the mandatory reductions? They're basically asking you to figure out the how to get to the net pay. And if you look at A9, that's actually asking how to get to the net pay. So these are the three parts. B8, B9, and A9 are gross earnings, deductions, and net pay. And it's all based upon the same information that is given in each of those, I believe. So you've got the hourly rate with time and a half over 40 hours. They worked 45 hours, FICA, federal income tax, and it just asks you. So we know how to calculate the gross earnings. It's $40 times the hourly rate, the overtime hours times the overtime rate. That's gross earnings. The mandatory deductions are the 7.65% times FICA, and all I've done is add the 20%. Now, I'm not asking you to actually look up on the income tax table. I'm just giving you a round number for an income tax rate. And let's say it's in South Dakota, so we're not even doing a state income tax. So 20% plus 7% times the 950 is the deductions, and that's how when you go to A9, you put those two pieces of information together to get to our net pay. If I look at B10, in January, gross earnings for the company total $10,000. So this is asking from the company's point of view. Let me actually back up and look at A8. No, I guess all of those are kind of the same. So B10, all earnings are subject to 7.65 FICA, 5% SUTA, and 6% FUTA. What is the payroll tax amount? Well, $10,000. And then you total all those three together, right? So SUTA and FUTA are 6% together. So I'm not actually asking you to break them out. If you look at B10, I'm just asking what's the total amount. And A10, I'm actually asking you to break them out into a journal entry. So the 1,365 is the same 1,365 in A10. Now I'm just asking you to put the correct journal entry together. A9 we've covered, and A8 is just doing a simple FUTA and SUTA calculation. The only thing here is, the only little trick is that, remember, it's only on the first $7,000. So you would do 6%. Well, here it's specifically asking FUTA. So it's 0.6% on the first 7,000, not 10,000. So even if they earn 10,000, the amount of FUTA would just be here $42 based upon the first $7,000. So that's the only little extra thing to remember about A8. I think I just want to point out that A8 is talking about an individual employee, so that's why we cap it at 7,000, whereas B10 and A10, we're talking about a number of employees altogether. So the assumption here is that no one has gone over their FUTA and SUTA, therefore we're not capping the FUTA or the SUTA on those two. Okay, if you have questions, I'm going to write a little bit more in the in D2L as far as information, but as far as recapping the exam and how to take it, between this document and the quizzes, you should be set to go. Thank you, everyone, for participating in this. Of course, it's always a little strange to have asynchronous. I don't have much contact with everyone. If you have any questions or if you have any feedback on things that you liked or you didn't like, feel free to let me know. Otherwise, if I see you again in another online course, just remind me that you were in this one as well. Okay, take care and have a good holiday break. Thank you.